What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, a podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. Hi, everyone. This is Ryan Pulis. Today, we're going to discuss one of the core financial statements every business owner should be familiar with, the income statement, also referred to as the profit and loss statement or simply P&L for short. In our last episode, we discussed the three main financial statements at a high level. Today, we're going to focus more on the income statement and dive into a bit more detail. So every company has an objective to provide goods or services at a profit. The P&L shows how profitable your business is over a period of time. That time period can be days, weeks, months, a year, multiple years, but generally it's going to be monthly, quarterly, or annually. The main accounts on the P&L are your revenue or sales accounts, followed by expenses. For most businesses, the P&L starts with revenues or sales and then subtracts cost of goods sold to arrive at gross profit. The gross profit tells us how much money is left over to cover operating and non-operating expenses. The cost of goods sold represent all the direct costs that go into your product or service. If you're selling a product, this is the cost of your inventory and any direct labor that go into making the product. The gross profit number tells you whether or not the business is selling enough of its products or services to cover its production costs. If you're a purely service-based business or dealing with rental real estate, you may not have a cost of sales line item on your P&L at all. In this case, your P&L would start with the revenues or sales or gross rental income in the case of rental real estate, and then goes directly into the operating expenses. Moving down the income statement, under gross profit comes your operating expenses. These are the costs required to run your business. This consists of expenses such as rent, insurance, your general administrative costs, office expenses, all those operating costs that go into running your primary or core business. The gross profit minus operating expenses equals net operating income. This is the amount of money left over after deducting all of your operating expenses and tells you how much income from operations your business is generating. Operating income is an indication of the company's earning power from its core product or service operations. Under the operating income line item are non-operating expenses such as interest. If you're a C corporation, you may also see income tax expense here. Operating income minus the non-operating expenses gives us the company's net income or loss. This is your true bottom line and represents how much money is left over after factoring in all of your expenses for the period. The net income or loss closes to retained earnings on the balance sheet at the end of the period, generally at the end of the year. When you analyze an income statement, there are some key ratios or calculations to keep an eye on. Different companies and industries may track additional ratios, but the three we're going to focus on today apply to pretty much all businesses. Three ratios we'll touch on are gross profit margin, operating margin, and net margin. There are dozens of financial ratios out there, but we're going to stick to these three for today. So the first, gross profit margin, this is calculated by taking your gross profit divided by total revenues or total sales. This tells us what percent of your sales are left over to cover operating and other expenses, and this ratio is used to analyze the company's efficiency in producing its products and services. Our second ratio is the net operating margin. This is your operating income divided by total revenues. The operating margin tells you what percent of sales makes it to operating income. This ratio indicates the quality of the business operations and can be used to compare different companies to one another. The third and final ratio we'll touch on today is the net margin, which is simply the net income or loss divided by total revenues or total sales. This ratio is a measure of the overall profitability of the business. So in summary, the income statement is one of the three main financial statements and shows how profitable your business is over a period of time. The income statement starts with sales or revenues and subtracts cost of goods sold to arrive at gross profit. Operating expenses then reduce gross profit to arrive at operating income, which is in turn reduced by non-operating expenses to arrive at net income or loss. That about wraps up our discussion today on the income statement. Thank you. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's THEPULICEGROUP.com/contact.